All right, let's get right to it. It's the TradeRobotX Daily Macro Brief for Monday, April 13th. Look, today is all about positioning. It's the quiet before the storm of tomorrow's critical inflation data and a whole slate of Fed speakers. So, quick check on the dashboard. Bitcoin is holding firm right in that $73,000 to $74,000 zone.
DXY is soft, sitting at 98.8. That's a key tailwind we're watching.
And yields, they're stable, right around 4.29%. Now, equities are choppy, for sure, but the VIX is contained. That tells us this is stabilization, not widespread panic. So what do we call this regime? We're calling it liquidity-supported growth with a volatility reset. Think of it this way. There's plenty of fuel from the weak dollar and stable yields, but there's an underlying jitteriness. This is not a clean expansion phase. All right, let's dig into that setup a little bit more. We've got a really interesting mix of signals right now. Okay, so here are the levels. The S&P is holding its ground near 68.16. Bitcoin is flexing above 73K, a very clear sign of liquidity. And the VIX, our fear gauge, is hovering around 1920. So yeah, there's caution, but definitely no panic. And here's why this all matters. Despite those jitters, money is still flowing into high beta assets. That's a huge tell. It means investors are still willing to take on risk, which is a constructive undertone for the market. So what's actually fueling all this? Well, it really boils down to two things: liquidity and inflation. WTI crude at $92, that's the wild card. As long as it stays below 95, it keeps a lid on immediate inflation fears. But over 90, that inflation ghost is always lurking, especially with tomorrow's PPI report coming up. And here's the liquidity engine. You've got the 10-year yield steady at 4.29. That means the market isn't pricing in some aggressive tightening cycle. You combine that with a weak dollar and you create the perfect environment for liquidity to just pour into the system. But, and this is a big but, this whole picture is fragile. All of this stability could get shattered tomorrow. A hot PPI number could send a shockwave through the market, causing yields and the dollar to spike. And that would probably put a very quick end to this risk-on mood. So, with that backdrop of supportive liquidity but simmering inflation fears, how are risk assets actually responding? Let's take a look. The S&P, near 68.16, really shows the market's split personality. You've got strength and instability at the same time. This tells us big players are repositioning their portfolios. They're not running for the exits. And you see that same dynamic perfectly in gold. At 47.42, it's pretty clear investors are hedging against that inflation uncertainty. When you see gold rising right alongside equities, that's a classic late cycle signal. Investors want to have their cake and eat it too. And then we've got Bitcoin. Holding that 73 to 74K zone is a huge statement. This isn't just speculation. It's a primary signal of just how much liquidity is in the market. If it holds here, the next stop could easily be 75 to 76,000. So let's just connect all the dots here. The chain reaction is clear. A weak dollar pumps liquidity into the system. That keeps yields stable, which reduces the pressure on stocks. And the end result? A controlled risk-on environment where the appetite for risk is still very much alive. So where do we go from here? Well, the path forward is going to be decided by two things: tomorrow's PPI data and how the Fed reacts to it. Make no mistake, tomorrow is a make-or-break day. The PPI data will tell us if inflation is really a problem. And then we've got a lineup of Fed speakers who could completely change the story on rates. That's why today is all about getting positioned before the fireworks start. So, how do we frame the potential outcomes? On the desk, we see three main scenarios playing out tomorrow. First, the risk-on path. Oil stays cool, dollar stays weak. We could see the S&P push to 6,900, Bitcoin tests 76K. Our base case is basically consolidation, the market chops around waiting, and the risk-off scenario. That gets triggered if yields spike above 4.35%. That would likely send the S&P down to test 6,700 and Bitcoin back towards 70K. So what's our call? The desk's view is that the bias remains slightly risk-on, but with a lot of caution. We think the market is going to wait for that PPI confirmation before making a decisive move. Which brings us to our final takeaway. Let's just zero in on the core tension that's really driving everything right now. In a nutshell, the market is stable, but it's not confident. You've got this flood of supportive liquidity on one side, and it's fighting against these unresolved inflation signals on the other. It's a tug-of-war, and tomorrow's data is going to be the tiebreaker. And that's your brief. So keep a very close eye on tomorrow's PPI and the Fed signals. Because the real question here isn't just about the next market move, it's about whether this entire liquidity-fueled rally can survive the month of April. The answer could change everything.